Hey folks, welcome back to the channel. This is Jason, host of Fighting Words Financial. And today I wanted to talk to you about something that may start to occur here pretty soon that's going to benefit everyone who pretty much already owns a home or already has a large amount of fixed debt. Okay, so I'm looking through a lot of the bad news that's happening today. The market's down again. And like I've spoken to you guys before, try not to pay too much attention to day-to-day news and day-to-day fluctuations in the market. The bear market often ends long before the recession does, long before the recession even hits bottom, and it does so a lot of times completely in opposition to the negative news and supposed negative headwinds that are out there. So keep your focus on the future here, and let's talk about what that future may look like, even if some of the more dire predictions of inflation happen, and how you can benefit from that, because trust me folks, you can actually benefit from this. So I'm going to go into a little bit of a story time here. I've been in the financial industry for almost 20 years now, and when I first got into the financial industry as an advisor, like I left kind of being a programmer and became an advisor, a lot of my first clients were basically folks who made all their money in real estate, but not all of their money buying and selling real estate, really just made all their money owning a home and then borrowing against it and investing it, right? So let's talk about how that happened, because it was kind of a neat trick that only worked for that generation. So I'm sure you guys have heard this from your boomer parents or all the boomers in your life who really aren't that much older than me, by the way, folks. I'm kind of old. But these folks are always talking about how they bought their house for such and such dollars, and now it's completely paid off, and now their house is worth $600,000, $700,000. These folks all had the advantage of experiencing something in the economy that folks younger than them have not. They are not financial geniuses. They were not enormously, disciplined, and they didn't make all the right moves. They experienced something called inflation-induced debt destruction, meaning if they bought their house in the late 60s or bought their house in the late 70s, that became an incredibly efficient wealth generator as the value of their property increased, their earnings increased, really because of wage and asset inflation. And then at the end of that that inflation period, say 1983 or so, a lot of times their debts had been paid off. Additionally, these folks in that time period, in a lot of states, they weren't allowed to pull money out of their house in the form of a second mortgage or home equity line of credit or something like that. So they had a house that was completely paid off by the late 90s in most cases. This wasn't this wasn't a case of genius on the parts of these investors, on these homeowners. Well, we're approaching a period where that may be advantageous for everyone that's out there right now. Now, I know that the housing market doesn't look great right now. New home sales fell sharply. The recession alarm is sounded here, and it looks like housing starts are about to decline as well, which means that the housing market may go through a bit of trouble here, mainly due to affordability. Basically, we've seen 2 percentage point rises in interest rates just in the last couple of months here, and that's basically priced anywhere from 30 to 40% of the folks out of the market. However, if you already have a home, I don't think I'd be too terribly concerned about the value of your home today, particularly if we are going through an inflationary period. Right now, the increased cost of borrowing is going to, and basically the lack of new inventory coming onto the market is going to have some serious negative impacts on the real estate market here going forward. But it's not going to last for all that long. People still have to get into homes, and as they get into homes, that you're going to see that market readjust, and it's going to start becoming advantageous to you. Typically, real estate doesn't always entirely keep up with inflation, but it does to a degree. It does help you out to a degree, particularly residential real estate does. But what happens here is that your expenses stay fixed in terms of what you borrowed the house for. Like my house right now, my mortgage payment is already lower for a 4-bedroom house than the rent is for a 2-bedroom apartment in my area. It's already significantly lower than that. So I'm already seeing some sort of inflation-induced debt destruction here, where it's actually cheaper for me to stay in the home that I own than it is to go out and rent a place. That's very soon going to be the case for everyone who has a fixed mortgage here. It's also going to allow you to pay that mortgage off faster if you'd like to. It isn't always the best decision. It's not something that I ever discourage in my practice, though, because there is a psychological benefit to being mortgage free that's kind of hard to put a dollar amount on. Yes, you can literally put a dollar amount on it by doing the math, but what I'm saying is the feeling and satisfaction you get and the sense of security that you get from having a home that's paid off is kind of hard to replace. And even though I can put an exact dollar amount on what it is, like I said, the emotions get in the way there when it comes to that feeling. But we're all going to approach that ability to start paying off our debt a lot more quickly if you are younger and still in the workforce. Now, if you're older and you're living on a fixed income, or you're approaching retirement and you're looking at inflation, this may be a different story. But if you are still in the workforce, your wages are going to rise as well, and you can put those wages to work for you in one of two ways. You can use that to pay off your debts, or you can use that to invest for the future. But anyway, the idea of inflation is not all negative because of inflation-induced debt destruction here, which is a phrase that I heard some time ago, a couple of years ago, that I'd forgotten about, but it reminded me of all of those smug boomers that I met early in my career that thought they were geniuses because they bought a house in 1968 for $20,000 and today it was worth $500,000. They only experienced inflation, essentially, and they experienced that inflation-induced debt destruction because they borrowed $18,000 in 1968 and basically had an $18,000 mortgage to pay over the lifetime, that they own that home, right? So you understand what I'm saying here. But we are approaching that period again. Don't think everything is negative going into this recession or going into this era of inflation. There are positives that can happen out of it, and that is one of them. Anyway, folks, that's the positive message that I wanted to leave you with today. Have a good day, and I'll see you next time.